Hey everyone, today I thought I would go over some reasoning why we should stay away from holding leverage ETFs over long term. Recently when the crude oil market crashed and we saw negative crude oil prices, many of my friends were asking me how do I invest into crude oil, as negative crude oil prices obviously can't be sustained. I'm glad I didn't have a crude oil position on at that time, because I never thought I would see negative crude oil prices. Seeing negative commodity prices just wasn't something that I thought was possible. Because no matter what, I would assume all commodities would have some kind of value. This was a special case with crude oil, because there was so much supply and so little demand, mostly all the storage facilities were full, and there was just nowhere to store the current supply. And traders wanted to offload all their future contracts to avoid having to take delivery of crude oil and incurring the storage costs. There are some future contracts that settle to cash, so instead of actually getting physical product, you'll get cash instead, but others actually settle to physical products. In this case here with crude oil, you're actually buying physical oil. So you actually get physical delivery of the crude oil, and you will have to arrange for it to be delivered, and then you have to store it. And each future contract of oil is equivalent to 1,000 barrels. And with all the storage facilities filling up, no one wanted it, and it ended with everyone selling their future contracts, causing the massive drop. And when the CME came out and said there was no low limit to where the price can go, and they made trade negative, which no one was prepared for, because I'm sure no firms out there would have expected negative crude oil prices. I know shortly after that, they raised the margin requirement in all crude oil contracts, and even went as far as to prevent people from trading the May and June contracts of crude oil. They were allowed to close the current positions, but not allowed to open any new positions. When crude oil turned negative, many of my friends were asking me how do I invest in crude oil for the rebound. I didn't want to recommend crude oil future contracts because they obviously didn't have the experience, because if they did, they would need to ask me. So I wanted to recommend a smaller product, which led me to recommending the ETF USO as a pure oil play. And on top of that, there's a floor price of 0. It can't go below 0 like the future contracts, so you know at least what your maximum risk is. Some of them came back asking me about a leverage ETF play on oil. When it comes to leverage ETF plays, long term the returns are never what you expect them to be. There's nothing wrong with them, but long term, just because of how the math plays out, the overall returns are not what you expect them to be. Don't get me wrong, short-term plays or for day traders, they can be a great tool because of the leverage they offer. We'll see why when we get into the math. Let's use the USO ETF and the 2-time leverage UCO ETF. Just for simplicity's sake, they say they're both priced at $100. And if a USO moves up 5%, then UCO will move up 10%, 2 times the move. Very simple. So at the end of day 1, USO will be priced at $105, where UCO will be placed at $110. Let's say the next day it moves down 10%. USO would then drop down 10% to $94.50, where UCO will drop down 20% to $88. Now if you look at USO, it has lost 5.5% from the initial buy at $100, but UCO has lost 12%, but 12% is not double that of 5.5%. There's a 1% difference. When you extrapolate that out over many days, the difference between what your expected gain or loss versus your actual gain or loss will vary greatly, and from my experience, it tends to be worse. I'm going to run a couple of random examples, and you will see clearly how this plays out, and the massive difference you can notice from your expected return and your actual return. So first let me explain what I did here. We have the starting ETF price at $100, and this is the same for the leverage ETFs as well. This here is the percentage move that ETF can move. I've set it from minus 10% to 10%. The first set of data is for the regular non-leverage ETF. The second set of data is for the 2 times leverage ETF. And the third set is for the 3 times leverage ETF. In the first column is what we expect the price to be based on the movement of the non-leverage ETF. So on day 1, the ETF moved a little over 2%, and we would expect the 2 times leverage to move a little over 4%, double that of the regular ETF. The second column is what the actual move is, so we can get a comparison of what we expected and what we actually got. When we look at a couple more examples, keep a note of the first few days. You'll notice that it doesn't deviate much from the expected move by a lot. But when we hold it for a longer term, it can vary drastically. For example, in this case on day 20, we notice the regular ETF has a return of almost 2.75%. So we would expect a return of about 5.5% from the 2 times leverage ETF. But that's not what we see here in this case. Not only is it off, it's negative. We lost about 1.3%. And the 3 times leverage ETF lost about 11.5%. The reasoning for this difference is because the firm has to reset its leverage daily. In a market that is oscillating back and forth, it can erode your returns. I also want to note, the last row 21, I manually set the return to bring the ETF back to its starting price, just to see what the end result of the leverage ETF would be, and from all the examples I saw, it's always lower than its starting price. Here's another example where I want to emphasize when the moves are in your favor, and when the leverage will help you greatly outperform the non-leverage ETF. In this example, the moves are only positive from 0 to 10%. The leverage ETF will always be greater than our expected return if we hold it for more than one day because of the compounding on top of each other. You can see just how significant the returns are, but the market almost never moves in one direction. Yes, it may be skewed to the upside, but not all the days are a green day. What if the moves are only negative? Even in this situation, the leverage ETF will still outperform the non-leveraged one. And yes, we may have lost more, but less than what we expected. So in conclusion, leverage ETF outperforms when the market moves in one direction, but underperforms when it oscillates back and forth. I thought I would show you a comparison between USO and UCO, the 2 times leverage ETF. Initially, when the price was fairly flat, oscillating back and forth, you can see a divergence between the two as a gap or the price difference between them expands and got further away from each other. But as the price collapsed, the difference started to narrow back, and as of now, the price difference between the two is nowhere near as great as it was before. Another comparison that many have looked at is the SPY versus SSO, which is a 2 times leverage ETF. You can see a very similar case here. When the market is oscillating back and forth, it underperforms. But when it grinds higher, it can really outperform. So, in conclusion, I don't recommend leverage ETF for long-term holds as it varies greatly based on how the stock moved to get to the end price. But if we set it in such a way that it returns back to the starting price, the leverage ETF will almost never be priced back at the starting price. The reason for this difference is because the firm has to reset its leverage daily in order to maintain its leverage. We can see that if the market moves in one direction, then leverage products will greatly outperform. But if the markets are oscillating back and forth, it can erode your returns. Because of these reasons, I don't recommend leverage ETF for long-term holds, and only for scalps and short-term plays. But these are just my own personal opinions. Please do your own homework and come up with your own conclusion. If there's anything that I missed, or if you have some interesting findings, please let me know down in the comment section below. And as always, if you enjoyed the video, please like and share the video. I really appreciate it. And if you haven't subscribed yet, please make sure to smash the subscribe button. And thank you for watching. I'll see you in the next video.